Over the past year, Rugpulls accounted for over 35% of all crypto scams, and this number is just getting higher and higher every year. Can you imagine how much is that? It's over $3 billion stolen from innocent traders like me and you who invest in DeFi projects. So, what are Rugpulls? How are billions of dollars getting stolen? And most importantly, how to stay away and reduce the chance of losing your money? Stay tuned. Welcome to Crypto Potato. My name's Chris, back with some more critical information you better know about the crypto industry. So if you don't like to lose your money to crypto threats like Rugpulls, make sure to subscribe to the channel so you don't miss any new episode, because we do these kinds of videos almost every week. So let's start with the all-important question of, what are Rugpulls? The term rug pull comes from the phrase to pull the rug from underneath someone, referring to a type of scam where the development team behind a decentralized finance DeFi project runs away with investors' funds by selling or draining its liquidity. What is liquidity, you now ask yourself? In DeFi, liquidity refers to the amount of cryptocurrency poured into a liquidity pool and locked into a smart contract. That's a requirement for operating an automated market maker and decentralized exchanges such as Uniswap. Just like with centralized exchanges, liquidity is essential in DeFi-based protocols as it facilitates users to execute transactions between multiple assets without causing massive price swings in the asset's price. Rug pulls are frequently associated with the DeFi space due to how simple it is to create a new cryptocurrency and get it listed on a decentralized exchange, DEX, without having to go through a Know Your Customer (KYC) process and running a third-party smart contract code audit that will ensure the code has no known vulnerabilities. However, keep in mind, an audit doesn't necessarily assure a project's legitimacy. How do attackers perform the rug pull? Now that we have a basic idea of some of the terms, let's see how rug pulls usually unfold. Most commonly, the developers of a project create a new token, usually based on Ethereum's ERC20 standard. But this is also common on other layer 1 networks such as Solana, Avalanche, or the Binance Smart Chain. The devs then list it on an open source decentralized exchanges like Uniswap, Radium, or PancakeSwap. Once created, the team have two options: to inject liquidity to the DEX via a liquidity pool in which the token is paired with a more popular cryptocurrency like Ether, ETH, or via an IDO, initial DEX offering, in which a project's token makes its first public debut on the DEX to raise funds from retail investors. For more legitimate projects, the proceeds are locked for a certain period after the token generation event, and this is how you can spot the first red flag. Whoever plans a rug pull usually doesn't lock up the liquidity in order to later remove it from the liquidity pool. Whichever way, the perpetrators usually promote the project with enough marketing to hype up innocent investors into buying the token. These promotions will usually include unrealistic APYs, which stands for annual yield percentages. The APY is a percentage of return earned on an investment for an entire year. Be careful, a high APY doesn't necessarily mean that a crypto project is a scam. However, it does translate into higher risk. Once enough victims are engaged and provide sufficient liquidity to the project, the scammers can sell their tokens all at once at a high price while draining the liquidity pools. Without sufficient liquidity, investors are forced to sell at a much lower price, losing a significant amount of money if they can get enough liquidity at all. Once all the liquidity is drained, the scammers often proceed to erase all traces of the protocol by deleting its official website and social media channels. How to spot and avoid a potential rug pull? There are numerous red flags we can spot to potentially prevent investing in a rug pull. As a side note, before investing in any crypto project, always make sure you do your own due diligence and understand the project you're investing in. And always invest what you can afford to lose. Anonymous team. This is a crucial factor you should consider. An anonymous team or pseudonymous profiles running a cryptocurrency project can be a sign to suspect, but let's elaborate. The way you understand anonymity is up to debate. There are plenty of well-known developers within the cryptocurrency field that haven't been doxed, but they have a verifiably proven track record under their nickname. Therefore, the fact that their real identities are unknown isn't a red flag. On the other hand, a fully doxed team without a proven track record should raise some question marks. Remember, don't trust, verify. Unclear white paper. The project might have a white paper, which is a document that outlines its purpose and its technical components. Written in an incomprehensible, ambiguous way and with a non-existent working model, meaning it's more conceptual with no actual product. Keep an eye on this one too. The white paper might be written in a way that looks more like a marketing play than actually offering something useful or innovative to the DeFi ecosystem. Disproportionate token allocation. If the token distribution favors developers, stay away from the project. This is also true for the seed and private investors allocation. You need to see how many tokens the team and advisors get and if that's somewhat proportionate to the public allocation. You can use block explorers like Etherscan to see how the tokens are distributed, the number of token holders, and how much each of them holds. Is there a suspicious address that holds huge amounts of tokens? If so, that's something to consider. A balanced token supply distribution usually translates to a safer investment. No lockup or vesting periods. After an IDO, developers renounce ownership of some of their tokens by locking up the liquidity pool, guaranteeing that the liquidity remains untouched for a sufficient period of time. No lockup periods mean that devs can drain the liquidity at any given time, forcing investors to sell at a loss. A lack of a comprehensive vesting period, on the other hand, might mean that the early backers and the team themselves are misaligned with the project's goals. This might translate to the so-called slow rug. This is a situation where seed investors who have no interest in supporting the project's long-term vision but have entered just because they had an opportunity to get in early, slowly sell their tokens over time, essentially crashing the price. A project that's gone through something of the sort typically has a chart that looks like this. Low liquidity and total value locked, TVL. Always check the liquidity of the DeFi project by looking at its 24-hour trading volumes, using coin indexes like CoinMarketCap and CoinGecko. If the volume is low, then it's easier for the dev team to manipulate the token's price. If the project that you're researching has some sort of staking mechanism or allows you to provide liquidity for earning an APY, then you should also consider the total value locked, TVL, in it. This metric is pretty much self-explained. It shows you how much money is staked and hence locked in the project at that time. The higher this number is, the more capital has faith in it. DeFi Rugpulls history. Let's check some of the major thefts that took place recently. Anubis DAO. Anubis DAO was a meme coin cryptocurrency marketed as a fork of Olympus DAO, a DeFi reserve currency baked by bond sales and fees from liquidity providers. Anubis DAO debuted with an initial coin offering that amassed $60 million raised from investors, only later to be transferred to a single wallet and rugged. Meerkat Finance. Meerkat Finance was a yield vault DeFi project launched on the Binance Smart Chain, BSC. A day after its debut, the protocol's vault suffered a security breach in which developers drained over $31 million. In reality, the Meerkat deployed contract was modified to allow vaults to be drained shortly before the launch. Lunar Yield. Lunar Yield was a Solana-based cross-chain yield aggregator launched on Solana's finance launchpad Solpad. The protocol's developers removed the liquidity after stealing nearly $10 million worth of several tokens. All social media channels and the official website were taken down shortly after. TurtleDex. TurtleDex was a decentralized exchange built on the BSC network. The protocol debuted with a pre-sale round that raised roughly 9,000 BNB, which in that time amounted to $2.5 million. However, the team drained the liquidity from the trading pools on BSC, exchanged the TDDX tokens for Ether, and then sold the funds on the Binance exchange. So, aside from promising an exciting future, decentralized finance is still considered the Wild West of the crypto industry. The ecosystem is full of opportunities for developers and crypto enthusiasts to explore and create new technologies. This is also true for investors who get to back them early on. But as with any booming industry, scammers and malicious actors will always try to find and exploit vulnerabilities in the ecosystem, or pose as legitimate projects, offering unrealistic returns with no working model whatsoever. This is why you should always do your own research before investing and always invest what you can afford to lose. And there we have it. I hope this video has enlightened and educated you on one of the negative sides of crypto. If you've enjoyed this video and felt like you gained some value from it, then please go ahead, like, share and subscribe to the channel. We really appreciate it, and let's be honest, it helps our channel grow and takes you just 1 second of your time. Thanks for watching, and I'll see you next time.